And I guess, Victor, you touched upon this a little bit, but why is it important to know if fundamental news has been priced into the market or not?
So this is something that is dodging a trader's mind consistently, and it's basically very difficult to know how much of a certain item of news has been priced into the market. So the most reliable way to kind of digest that would be to look at the price action after a certain news item hits the wires, and that's something that a lot of traders are missing, and they feel like they know what the market is expecting, judging by the average consensus estimate. However, in reality, they don't know what portion of the market is looking at what consensus numbers, because obviously these average consensus numbers that are published on economic calendars are usually an average, and that's pretty much it. So if there is 10 traders which are looking at the top forecaster, they have the biggest volume in the market, they have a completely different approach to this matter. So yeah, this is something that traders should be mindful of.
And does news affect the OVI indicator, or is the options indicator not focused really on news for Guy?
Well, it's very interesting, because obviously what goes into the OVI includes pricing. So you're talking about implied volatility, and obviously implied volatility, which is obviously focused on the time value portion of an options premium, will deviate significantly in the lead up to earnings and in the aftermath of earnings in particular, and if there are other factors going on, but particularly pre-earnings and post-earnings. So there is news, or anticipation of news and anticipation of future events, woven into options pricing anyway, as much as woven into pricing of the underlying, if not more, in that respect. Now, the question is, as Victor said, is what do you interpret from that? And obviously without the benefit of hindsight, because if that's the one piece of the game we don't have, that piece of the puzzle. Now, what we do see with OVI in many instances is correct analysis being done by way of what the OVI is saying in the lead up to earnings, and then when you see the aftermath of earnings. And there are other factors involved, of course, but sometimes you look at it and you go, boy, oh boy, that had to be someone with better information than the masses. Had to be. I mean, it's just, and we are speculating, of course, because we don't know for a fact, but the way the indicator turns, and then suddenly there's like a takeover announcement, or a brilliant earnings, or a terrible earnings, and it's been there in advance. Now, of course, that's not going to happen every time, but there just are times. I mean, normally the best use of OVI for discretionary trading is when we're already on a trend and we're going to go forward with more of a trend at a low risk entry point. But there are just times where you see something change its personality from an OVI perspective, and then in the days and weeks afterwards, the stock price follows. And that's really, really interesting to see. And of course, it's not going to happen every time, but there are markers from a quantitative point of view and from a discretionary point of view that go, oh, that's interesting. And we go out with the expression, someone somewhere knew something. And we know that happens in the stock market, and actually we want that to happen, because that's how we can, otherwise prices would always be the same. But there are just times it picks it up very nicely. So of course, one of the things that we work on all the time is how can we pick up those times more often than not. And so that's the game. That's our particular niche. And of course, there are zillions of different niches out there in the trading world, some of which are a little spurious and use data that's not really connected with stock pricing and stock markets. If you go to, looking at planets and moon cycles and sunspots and all that, that's something we find a little bit strange because there's no actual link and it's just too far-fetched for words. But we look at demand and supply in terms of the shares themselves and the pricing, of course, and in terms of the derivatives as well. And we think that is a little more logical and a little easier to defend in terms of a methodology. So, I'll put it to you this way: we work with funds and etc. and professionals. Now, if you go to a fund and you say, and they ask what your rationale is, and you say, well, I'm looking at the moon and seeing what they're just going to think you're a whack job, right? And they would be right to think that. Whereas if you say, well, look, we're essentially looking at demand and supply at a specific level, then that's a little easier to defend.
Isn't it like whoever wins the Super Bowl determines who's going to get elected for the presidency or something like that? All these disconnected things, they're good fun, but they fail quantitatively. And so even with our discretionary strategies, we look to see if there is a mathematical edge underpinning it first. Because if there is, then it's not just being quite a skilled trader in terms of managing your risk, which is an important part of trading anyway. It's that, look, I'm going into this game and underlying the entire game, there is an advantage that I have here. I'm playing, now I can still screw it up by bad trade management and just, bad trading, because you still need that part as a discretionary trader. But, if you're playing a game that has a dice that is already slightly tilted in your favor, then you've got a better chance. And obviously, if you're using logic, then that reduces the noise of all these other weird and wonderful things out there. And I don't want to say too much, just in case you guys are into the moon cycles and sunspots and stuff. But there's one, I won't mention names. There's one quite famous market commentator. He sells a lot of newsletters, he was talking about his thing, and I'm not going to mention what he does, what he focuses on, because then you'll know who it is. But it had some sort of potential basis in economics. And then he said, he goes to me, well, what I found really interesting is there's the 29-year sunspot cycle. And I was going, oh, God. Yeah. God, okay. I think I'm going to switch off right now. I think this is a guy, because if you're really looking at 29-year-old sunspots, 29-year cycle, then I think your core methodology probably isn't working and you're grasping at something that is rather spurious. Now, if anyone's insulted by that, apologies for the offense caused, but truly, there is, if you look at what Victor's doing, Victor, you're talking about real news, real economics, real factors that one can actually defend. And these other things, that we're talking about, like sunspots and lunar phases and this, that, the link is just not direct enough by any stretch. It's very far-fetched. So, I like to be grounded in the reality of demand and supply.
Well, as a very famous contemporary philosopher and options trader said, anyone can get fooled by randomness pretty easily.
And that's part of the game that we're also up against, is just noise.
Yeah.
And that's why in our fund management businesses we go longer term, but obviously in discretionary trading, you have to be a little shorter term, but then we're hit by more noise factors.
Oh, the noise.